Okay, good afternoon, good evening, everyone, and also good morning to our speaker. Today, we are very pleased to have Victoria Ivashina from Harvard Business School, who will talk to us about why dollar debt is cheaper with some evidence from Peru. But before passing the baton on to our speaker, let me say a few things about our speaker, who is a very accomplished academic and economist with a number of fingers on a lot of different pies, if I may say. She's the faculty chair of the Global Initiative for the Middle East and North Africa. She is a research associate at the NBER and CEPR. She is a visiting scholar at the Federal Reserve Bank of Boston, Boston Fed, and a member of the Model Validation Council at the Board of Governors, and the list goes on. She has an amazing publication record, including publications in top journals like QJE and JME. And she has a research interest in the overlap of financial intermediation, corporate credit markets, global banking operations, asset allocation by pension funds, and so on. Our speaker holds a PhD in finance from NYU Stern School of Business and a BA in economics from Pontificia Universidad Católica in Peru. And we really are very happy to have you here with us, Victoria. Much appreciated. And the floor is yours. Let me unshare my screen so you can share yours.
Okay. Thank you very much for the kind introduction, Ozar. And thanks for the interest in my research. So let me just make it full screen and we'll go from there. All right, so this is joint work with Bryan Gutierrez, who is a PhD student at Minnesota now, and Juliana Salomao, who's a faculty at Minnesota. Okay, so the question is, we are trying to contribute to the question that asks why the dollar level of credit in around the world is so high. And of course, the surprising fact is that if you think through history of financial crises in outside of US, the dollar mismatch either on the balance sheet of the banks or on the balance sheet of the firms is kind of one of the key pieces in understanding the dynamic of the crisis. And that, of course, goes to Asian financial crisis and more recently the Turkish crisis and so on and so forth. And yet, despite those dramatic lessons, we kind of see again and again dollar credit becoming prevalent in the countries. And so the question is why that is the case. And of course, there are multiple narratives. We're going to focus on a particular point, which is trying to illustrate the fact that there is a significant discount to the credit issued in dollars. For that, we're going to use a micro data from Peru, but I'll also show you that at a high level, this is generalizable. And I apologize, I have to get the cat here out of the room, otherwise he's going to get a havoc. 1 second, please. Sorry about that. All right, so importantly, we will show that the 2%, and I'll be very clear about how strong that evidence is, but everything seems to indicate that the 2% is coming from the deposit side. And perhaps that is not surprising, right? But what we managed to establish it and bring it all in the same narrative, in that ultimately it seems like it appears that the inflexibility of the demand for saving in dollars, which is ultimately what generates this discount on the cost of dollar financing, which is then passed to the firms that borrow. And as I will show you as well, of course, the key part of this narrative is the fact that banks do not have a way to arbitrage this. They don't have an ability to put this cheap financing that they're gathering in dollars toward any other uses. And they are basically being constrained by regulation and being constrained in the type of uses that they put to their funding. This is being pushed to the balance sheet of the firms through this pass-through of the cost. This is a narrative in a nutshell. We are not ruling out several other explanations that exist out there, and they are at play. We just simply kind of build this point. And by the way, the motivation for this point is that I get exposed to quite a bit of debt financing in context of emerging markets for private equity transactions. These are incredibly sophisticated group of investors. So this is not naive ideas that somehow just because of differences in inflation, the FX fluctuations, there might be difference in the interest rate. So this is just a repeated answer about the fact that, well, we borrow in dollars because it's cheaper comes from a very sophisticated group. And this is what kind of was at the root of can we understand by how much is it cheaper and is it truly cheaper? Now, you can see a list of other explanations that are out there. And for example, one of the explanations is the so-called carry trade. And indeed, we will be relying we need carry trade. And if I get to the last slides, there will be some evidence for the presence of the carry trade. Because ultimately, you do need firms to take on the exposure to the FX. And that is what we tend to call carry trade. But part of the motive for taking on that trade is because it's incredibly profitable, and that's the point that we're trying to make. The last point is probably those are two theory papers, and those are probably closest to the narratives that we are trying to present here. And Bacola and Lorenzoni model, but particularly fits very nicely to what we are saying here. Now I see some comments in chat, and I wasn't sure if I'm expected. Okay, I see that.
No, nothing so far for you, Victoria. Sorry.
All right, and I see that Ellie says, please say hi to Susan Collins. Hi, Susan. It's a pleasure to have you here on the call. All right, so let's look at the data and the stylized. At the core of the study will be this unique data set that was collected by the regulator in Peru that tracks origination of credit in both domestic and currency and dollars. No other foreign currency is relevant in that market. And importantly, it also tracks the interest rate on those loans. Typically, as you might know, in this type of studies, we rely heavily on the credit registry, and we will do so too. But credit registry has two disadvantages. One is, first of all, credit registry is a stock, not a flow, but that can be overcome, and many studies did so. Importantly, credit registries typically do not have interest rates. And so that's why this additional data counts. So we have no ambiguity that we observe a new loan because it's a flow data, and we observe interest rate by type of currency. And you can see that we can combine it with credit registry, with tax information, and several other sources. All right, we're looking at the summary stats. And what I'm showing you here is, immediately you can see that the very first line tells us the interest rate for our sample in local currency is 7.1, in dollars is 5.2. It's no different or not any significantly differently for foreign banks, and this will be an important point. Nothing that I show you is coming from exclusively from domestic or foreign banks. So all the statements that I'm making are generalizable to foreign and domestic banks. So this is not the channel, potential channel. Firm characteristic, everything else that you see that is quite similar. So of course, these are these are raw rates, and part of the exercise will be to adjust it for UIP. All right. So one thing that we would want, this is, I think, that is established point in the literature. Nevertheless, let me bring it up. Because if I look at the dollarization of credit in Peru, right now it's about 40%. Historically, it's been much higher, but 40% is still incredibly high, high volume of dollars that is issued, credit that is issued in dollar for an economy that is not exactly 40% in exports. So here, but nevertheless, a typical criticism that might be out there is that, well, firms that have their revenues in dollars are the ones who borrow in dollars. And therefore, at the end of the day, it's not fully clear that we are able to pick up on the mismatch, currency mismatch. Well, here I'm trying to rule that out. And I'm kind of trying to say that it's not only the fact that on aggregate that there is 40%, we actually can start looking at the firm level, and that the currency mismatch will be there. So first, the two-colored graph on your left is about, so you can make simple sorting of exporters and not non-exporters. And already there you can see, granted, exporters borrow a little bit more in dollars, but ultimately this is a phenomenon that's persistent across the two groups. More interestingly, in Peru again, the regulator was experimenting of how to avoid having exposure to effects on the balance sheet of the borrower. So they forced banks to classify their borrowers in very exposed and exposed to effects and non-exposed to effects. And the way this is done is a bit of a black box. However, what we know that it does account for what fraction of the revenues is coming from exports. So this is going deeper because, of course, not every exporter generates 100% of revenues in dollars. So this allows to dive deeper into the composition of the revenues. Furthermore, to the degree that there is any hedging, that is also accounted in the classification. So this is, as you can see, this is a more sophisticated measure. And here I'm sorting it to you by industry to show, because, for example, mining and fishing will be exporting industry. Activities, services activities, of course, are not. And again, you can see that across the industries, there is significant exposure on the balance sheet of the borrower towards the dollar credit. All right. So we can rule out that there are some hidden compositional effect out there, that the dollar exposure on the balance sheet of the borrower is real. And it's going through the credit because this is classified as a. This is a very rough way to look at where we are going with this. These are just raw rates, nothing else. And what we are plotting here are differentials. So we take lending, so that's the top line, and we look at the loans in dollars, we look at the loans in local currency, and we plot the difference on the two. Then we take deposits, and that's the blue line, and again plot the difference between domestic interest rate and domestic in domestic deposits and those denominated in dollars. And finally, we plot the difference between the two central bank rates, Peruvian and the Fed. As you might know, in constructing the UIP, uncovered interest rate parity, we would use the red line, right? And so if one of the takeaways from here is that you immediately can see that use of that UIP would be incorrect in trying to understand the behavior of or trying to understand the role of the cost of credit in dollars in explaining its prevalence. Because as you can see, the two lines are kind of not related much. On the other hand, it's very clear that the deposits differential is very closely tied to the credit differential. And this is kind of at the core of what I will be showing you in a more granular way. But the point here is that there is something about deposits, that is deposit behavior, that is dramatically different from the behavior of the government rates. And that is in turn seems to be tied closely to the differential in credit. So what we're going to be doing now is kind of trying to establish this in a very clear way. And if there are any questions, please don't hesitate to interrupt me. Right. So what we're doing here is that we're taking interest rate on the loan. So each observation is an individual loan. And it's our dependent part. So we try to explain the interest rate with a set of factors. So in the very first column, what we're doing is we have firm fixed effect. So the firm level is removed from the equation. And throughout the analysis, we're going to have bank quarter fixed effects, which, by the way, means immediately that this is not explained by foreign banks or domestic banks, by large banks or small banks. But as I said in the paper, we also kind of show the graphs separately for domestic and foreign banks. So in the first column, we just kind of look at the difference between domestic loans denominated in domestic currency versus loans denominated in dollars. And that's the 2%, the 2.2% that we get in the very first line. So that's the dummy that kind of picks out the differential. And as I said, it has some basic control at the first regression. After that, we start escalating the level of controls. Now, in particular, in column 2, I'm looking at the industry quarter fixed effects. Now, think about what is the gold standard for us to kind of pick up this differentials in this type of studies. Typically, if we, in a traditional Quadrant-Meehan style, we would have a borrower quarter fixed effect, right? Now, I'm going to show you that result, but I don't think that this should be our starting point, because what that requires me, that would be effectively a comparison within borrower across that is taking a loan in two different currency in a given unit of time, be it months or quarter in our case. And that to me is a company that is very strange, right? So the subset of companies which does exist, and I'll show you in a second, but they are simultaneously borrowing in two currency. I don't really understand why they're doing that, and it's a strange behavior. And so as such, I kind of feel like this subsample might make us feel good on some statistical level, but it's not really an economically representative subsample. Anyway, I'll show it to you, but that's why I don't just on principle think that that's not the right way to go at the beginning. Instead, we're going to look at the industry quarter, meaning we are comparing loans within given industry at a given point in time. And again, as I said to you, throughout the bank quarter fixed effects are removed. So any differentials that are specific to any bank in a given quarter, that's taken out. So, so the first three columns, that's what it is, and it kind of escalates it. Column 2 and column 3, you can see that it has firm, the last column is the most robust in terms of identification, and it has removes firm fixed effects as well as industry quarter fixed effects. Let's look at the last two columns. In the last two columns, I'm bringing in the effects that I illustrated to you with those colored graphs, the importers, exporters, as well as the exposed, not exposed. What I'm trying to show you is that if I add up that effect, I'm actually going to get the right sign, but economically, that's not going to put a dent on my main result, which is the very first one. So, for example, let's look at this exposed, not exposed. So that's a column 4. So if I have an exposed borrower, I should charge them more. However, and you can see that that's what they so if they borrow in dollars and they are not the type of the firm who should borrow in dollars, there is a risk on the balance sheet of the borrower, and the lender should charge for that risk, which they do. That's what 0.209 stands for. But as you can see, economically, that coefficient is not that meaningful in the context of the minus 2 percentage points differential that we are getting. Similarly, if we move to column 5 and think about, okay, well, let's look at exporters. Exporters are actually less exposed to balance sheet mismatch. And as a result, they represent less risk and should be charged lower rate for their credit in dollars, which they are. And that's what minus 0.326 stands for. But again, in the context of the main result, the first line, that's not so meaningful. Now, of course, the reaction that you should have is to say that we are looking at the roller rates. Evidently, the dollar credit should be cheaper because the inflation in the US is lower than inflation in Peru. And so if we are just in the immediate thing that we need to do is to incorporate UIP. It's not completely trivial how to incorporate UIP here. And this is why we started with some basic results, and now we're gonna fine tune. Also, in the last version that we are revising, we're gonna reshuffle the order of the results. All right. So there are a couple of things that you have to take into consideration. So this is the adjustment that we're gonna do. Remember, the variable on our dependent variable is an interest rate. If it's in local currency, it stays as is. If it's in dollars, we're gonna adjust it. We're gonna adjust it for UIP. Remember that the adjustment for UIP needs to factor in maturity of the loan, because it's about evolution of the effects over the maturity of the loan. And actually, we are able to do so. It's not too granular, but there is a reasonable granularity in how we do that. And so we are able to incorporate the maturity. All right, so we're gonna plug this in. And so now our dependent variable is modified and it's adjusted for UIP. And I'm gonna show you exactly the same result with exception of column 6. But now my dependent variable is adjusted for UIP. By the way, in the previous result, I forgot to mention that there is a set of long control and firm level controls, and you can see that in the paper. I'm not going to walk you through columns 1 through 5. The only difference between what we did before, so 1 through 3 is escalation of fixed effects. 4 and 5 tested for compositional differences in terms of exposure to the FX mismatch on the balance sheet of the borrower. And you can see that the first line is very stable. Now, in the paper, there is a significant fraction, there is a long appendix, because what confuses people oftentimes is the following. If you go into Bloomberg or whatever is your source of information, preferred source of information, and find the depreciation of sol, Peruvian sol, over this period of our sample, you will find some number that is not 0. And therefore you will say, well, wait a second, how is it possible that you started with -2 discount for dollar credit, and now you're adjusting for UIP when the FX depreciated over the sample period? And how is it possible that your numbers are not moving that dramatically? So the answer to that is that what you are grabbing is the number that is an average of across quarters in a sample period, whereas in this case, it's a micro UIP. So the one is about the macro number, and this is a micro number. So this is affected by the distribution of the loans in the sample. And so in the appendix, we kind of provide, there is no really easy way to explain it without going into a long example. But the core of intuition is that whatever you cannot grab macro numbers and combine them with a micro level analysis. So the adjustment here, it has to be matched at the loan level. and it has to be this weighted at the loan level, and that's what creates a difference. And as I said in the appendix, we provide an example that kind of walks you through that point. Now, another important point here is that I'm adding a column 6. So what happens in column 6 is, because you could say, well, wait a second, it's not only about the expected depreciation, and that's the number that, by the way, we use in creating adjustment for UIP. It's expected depreciation of the dollar. And for that, we get the data that we think is a state-of-the-art data. But you could also say, well, it's about risk. I also take into the account potential fluctuation in the FX, and the column 6 tries to do that. Not only it accounts for the level of UIP, not the level of expected depreciation, but it also incorporates the standard deviation of the FX. And the reason why we're able to compute it is because we actually observe separately data on a hedging activity. So about these borrowers, and a result specifically for these borrowers I'm not showing you, but those contracts, the hedging contracts, allow us to back out the volatility in the FX based on the contractual data. So one final thing that I want to show you on this -2%. So this entire first part is just about establishing very clearly that there is, adjusted for UIP, there is a significant discount. And so what this does is this is a subsample. So you can see that we went from 87,000+ observations to 11,500 observations. And this is a subsample that actually has borrowers that take a loan in dollars and in soles in the same quarter, which is what allows me to plug in firm quarter fixed effects. So for example, if you look at, you can see that columns 2 through 5 have the firm quarter fixed effect. So let's focus on column 2. And you can see that if I look at the borrowers for which I can compare the differential in rates for the same borrower within the same quarter, I will still get the -2%. So that should clear your concerns about potential demand factors on the background, which we ruled out that this is about some composition of their revenues, but nevertheless, you might still have some lingering concern. So this should put it to rest because it's within borrower comparison. I'd like to generalize this result. So this is about Peru, but this is, and I see Ellie raised his hand. Ellie, go ahead.
Victoria, this is very interesting. You also said that if it's a European bank, they would shift from euros into US dollars they would swap, actually, you said. And I know this is true. It's also true for Japanese banks lending in this market. They would shift through the swap market from yen into US dollars. Should you take account of that swap spread, which may reflect bank counterparty risk, and this may change over time?
Yeah. So this is one thing that we try. So in view of the feedback that we got from in the submission process. So the referee does wants us to separate. So it seems like we pretty clearly can establish that there is UIP deviation in this particular sense and establish the measurement of that in the sample. But the referee is exactly trying to make us think about the potential covered interest rate parity element.
Yes,
I do not have answer right now, because partly because is actually quite tricky to have that, to get that data. But this is something that we are trying to working on incorporating into the data.
Okay,
so unfortunately, I don't
it's
have
probably,
an answer.
I think it's probably small, Victoria.
Yeah. That's our sense, but again, it's resulting to be less, not so easy to implement. And so at the moment, we kind of, part of why we are a little bit stuck is because which data to use and how to get hold of the right information for this purpose. But it is a good point, and hopefully, Ellie, in the next draft, the answer will be that. So let me show you. Let me try to generalize this. All right. So first problem, and which is why this data in Peru was such a fantastic window into this problem, is because typically we don't have interest rates. We do, however, have interest rates on deposits that you can just collect from the central bank's websites, right? Which is exactly what we do. So, so the first 4 columns are deposit rates. And so you can see a range of Latin American countries. This is a larger sample than the ones where we have the data for Peru. So this goes back to 2001. Nevertheless, you can, if you kind of go to the line and the spin for Peru, you can see that the numbers that we are getting is very close to the ones that we observed in our sample. So what do we see here? So first, you see the deposit rates for column 1, deposit rates in foreign currency. Another caveat is that central banks don't tell you if it's dollars or not dollars. We know that dollars is a dominant currency. It's definitely the one in Peru. Nevertheless, there might be some euros mixed in there. So foreign currency deposit rate, second column, local currency deposit rate, third column, the difference between the two. Okay, so you can start seeing that these numbers are very big. And the next question is, what does UIP do? So if what piece of this can be explained by the UIP? And you can see immediately that this is not kind of gonna give you the answer. So the differential in the rates that you observe is far removed from the differential that you're gonna get with UIP adjustment. And then we look at the rate differences between on the differentials in deposits and in central bank rates, as well as adjusted thinking about this on the UIP adjustment. And so all in all, you can see that there is a very persistent differential between rates that are paid for local currency deposits and foreign currency deposits, and they are far removed from the differentials that we observe on central banks. You can see they're close to 2% for Peru, even though it's a very different sample. And you can see that all these are significant magnitudes across all of those countries. Then that's kind of the puzzle that we are bringing up, and so this is consistent with. Seems to be consistent with the evidence that we find for Peru. There is something large in magnitude that speaks about this significant economic cheapness that is not incorporated in the central bank rate. All right, so let's think about where can it possibly be coming from. And I already showed you very rough indication of what might be the story in showing you that if you just plot differential over the time for loans and plot the differential on deposits, it seems to be coming from that. Let me be clear. This paper kind of, if you think about it, has 2 separate parts. One is about establishing the discount, the economic discount on the dollar credit vis-a-vis local currency credit, and that's -2%. And now we're kind of moving into the second part of trying to understand where it's coming from. Ultimately, I won't be able to, in the second leg of the narrative, I won't be able too tightly to trace the causality from deposits to dollars, from deposits to dollar credit, but I think that our evidence will be suggestive enough to kind of tie up this paper. Right. There are three pieces, however, in this entire story, right? There are depositors, there are banks in the middle, and there are borrowers. So on the borrower side, we already said, look, it appears that if you come to the bank and you can save 2%, and that is adjusted for FX fluctuation, that seems like a significant economic difference. Let's think about what banks are doing in the middle here. And our story will be that banks are very, actually, well, first, I mean, there is anecdotal evidence in that the banks are constrained from using this cheap dollars that they're getting from deposit for purposes of buying US bonds. The amount that they can invest abroad is very constrained, which is kind of not surprising, right? Most of the economies, and especially emerging economies, make sure that the local savings are reinvested locally. The second part about this, about the banks, is that the regulation is such that their balance sheet is very tightly matched. And this is what I'm showing you here. We are looking at dollar-denominated liabilities and dollar-denominated assets, and we are tracking it over time. And you can see that domestic or foreign, this is incredibly closely matched. Not surprising, because as you might know, precisely because we very well understand that FX mismatch is such an important part of the unraveling of the economic crises in emerging markets, many of the countries passed very strict regulations. Of course, the problem is it's very easy to tight the balance sheet of the bank, but still doesn't free you from exposure on the borrower side, right? The borrower can still carry mismatch on their balance sheet. So you can just kind of pushing it out of the system, of the banking system, but that doesn't fully resolve the system. This is the problem. Regardless, the regulation in Peru is the following. So it's asymmetric depending on whether your exposure is on the asset side or on the liability side. That's not so relevant for us, and it's actually not surprising that such regulation will be asymmetric. Importantly, you can see that it's rather draconian, right? So if you have a mismatch, if you have more dollars on the asset side, you will have equity capital requirement of 2 times the exposure. If it's on liability side, then you're going to have 10 times the exposure. Now, again, not surprising that it's asymmetric because liability side is runnable, right? What's important to us is the fact that the regulation is such that it makes it incredibly costly for a bank to carry a mismatched balance sheet. And not surprisingly, I just showed you the evidence that the balance sheet is very tightly matched. Now let's shift to the deposits. So banks seem to be banks seem to play a very passive role in all of this, right? As we said, we put this strict regulations that kind of forces them pass whatever dollars they get on the deposit side into the credit, nor they can get to use it in many other ways other than passing it to the credit, to domestic credit. Deposits are an important source of financing, and specifically dollar deposits for as part of dollar liabilities. And here you can see this decomposition for domestic and foreign banks. And this is generally also very representative of the way this looks for other emerging markets. And so let's shift our attention to deposits. And to establish the connection between the deposit side and the liability side, I mean, first, the intuition is rather simple. If you think about the bank that is constrained, so the bank has to match. So whatever they get on the deposit side, the intermediary simply passes it through to the asset side, to the credit. Then you can think about the fluctuations on the deposit side will just be passed through. The part that we want to illustrate here, and I'm not going to go into the model. Let me just skip it. This is really I mean, initially we didn't even have the model, but then we ultimately found that it's kind of we needed to fix ideas. All this is trying to say is that, okay, of course there is an elasticity that is that is attached to the deposits and loan sides. Imagine that you shock the bank with an increase in cost of gathering deposits. You have to ask yourself, is it going to be on the, are you going to amortize that cost, and you're in a competitive setting, so you're not going to absorb it yourself. You're going to either pass it in the cost of credit or in the compensation that you're paying in deposit. So if there is a shock, the cost shock, it goes in one direction or the other. This entire little model basically pins it down to say that if the deposits are incredibly inflexible, if the demand for dollar savings is so high, then what you will observe is that any shocks to the costs will pop out on the adjustment in the deposit rates, and then that in turn will be affecting the cost of credit. Let me show you exactly what we're going to be doing empirically. Again, this is ultimately, this is kind of just to hold your thoughts of how you're going to have this interaction between liability side and asset side, and that it's a function of the elasticities on the both on the both sides. Bank is just a pass-through institution that is operating in a competitive setting. You can see there the conclusion. That's exactly what it's trying to do. Let me show you what we do empirically. Again, the model is there. If you're curious about it, to us, it's a simple way to hold your thoughts, just to formalize what we are thinking here. But ideally, what I would like to show is the following. I would like to have a shock that hits a bank. And I would like to show you that what will happen is that it's going to be pushed into the cost of the deposits. It's not really about, it's not going to go so much on the credit side. It's going to be really adjusted on the deposits. The other thing that I need in such an example is that it needs to be differential. I need the shock that applies to dollars in particularly, dollars on the balance sheet of the bank. And I want to show you that it's the adjustment, because in flexibility of the demand for saving in dollars, the adjustment going to be passed to the savers in dollars. And then that's kind of through the matched balance sheet going to leak into the credit. So what I'm, of course, I mean, imagining such shock is nearly impossible, right? All of this is endogenous. There is, it would be too much to ask. However, let's focus on the following. So this is what we're looking at. So these are adjustments on reserve requirements. And this is over our sample period. Of course, reserve requirements is a monetary policy tool, right? And the nice thing is that reserve requirements operate separately for dollars and for soles, right? And here on the y-axis, we are plotting changes in different policy moves, but we only focus on differential policy moves. For example, if the reserve requirements would be continuously moved in the same order of magnitude for dollars and soles, then all the dots would be on the zero, because there would be no difference, right? Instead, you can see that the adjustments in the dollars and in soles for the reserve requirements, they not exactly in sync. Most of the time they're close to zero, but not always. What we're going to focus on is a policy move that was actually triggered by the concern of escalation of the dollarization of credit starting to flatten out. As I mentioned you, in Peru, if you go back to the 90s, the dollarization of credit was close to 90%. I told you that in our sample, it's about 40%, which is late 2012 forward. And so what happened in Peru is that it kind of got stuck around 40%. And so the government started to experiment with what else can they do to kind of make it continuously going down. So what they did specifically in December of 2014, you can see those red dots and then 10%. So they all of a sudden moved the reserve requirement they moved them both, but the dollar one was moved by some dramatic amounts. It was actually a sequential adjustment of 10% twice, which is why there are two dots very close to each other. They were announced simultaneously. So you can see that they moved it in December 2014 by 10 percentage points and then an extra 10 percentage points. And of course, reserve requirements, what this means is that if you get $1 and your reserve requirement is 20% for dollars, that means that you can only use 80 cents for purposes of credit. So it's pretty clear that this is a shock to the bank in terms of the cost of funding, right? Now, the fun part about this measure is that then in December of 2016, they undid it in one move because they considered it that did nothing. And in one move, the entire 20% was removed. So the two dots on top add up to the one at the bottom. Now, there is not a chance that the timing of this event was somehow exogenous. There are no surprises. We know that there was some concern. What we think is a surprise element here is the magnitude of the move. And you can see that the magnitude is a complete outlier in this context, right? The other thing is that the x-axis here is expected exchange rate depreciation. So in case this is kind of addressing the point that maybe you think that when this policy moves were done, there was something incredibly unusual about the expectations of depreciation. This graph kind of makes point, no, because in periods of higher expected depreciation, you had much lower typical moves. All right, so let's think about it. So this is what's going to happen. So you can see the policy is the one that looks like a trapezoid, is the line that goes up. And you can see this quick escalation of reserve and then that being undone and one move down. And what we see here is that I'm plotting you deposit rates, and I'm focusing again on the differential between compensation for local currency deposits versus dollars. And what we see is that actually that gonna make banks pay way less on their deposits. Precisely the point that we were trying to make, that this is a shock that will be passed through to the depositors. Because originally it's not clear that the reserve requirement should go to the depositors. It could go to the depositors, so it could be reflected in the cost of credit. It's a function of elasticities on the two sides. What we are trying to prove is that through this example, is that the flexibility of depositors is very minimal. You can pass any shocks that you experience on the cost side, you're going to pass it as a bank to the deposits. And this is kind of consistent with these dips in the interest rate. So they start paying even less on the dollar deposits. This is what we do here is we kind of put bookmarks and say, imagine that the entire change in reserve requirements would have been passed to depositors. Nothing adjustment on the credit, entirely on depositors. So that's one extreme, right? And this is what the benchmark model means. If it's entirely passed to the depositors, we would expect the adjustments in rates of 0.287. Instead, what we see, and then we can calculate the opposite, say, let's say it's entirely goes to the loans, and that gives us the other bookmarks. And so we do this separately for the two events, the two-step escalation and then bringing it down all the way. And you can see that in both cases, we fail to reject that the actual adjustment on that we observe in the reduction in the compensation on the dollar deposits is can be rejected against the model. So it's gets economically very close to this limit where all the cost adjustments of the that result from this differential move in reserve requirements kind of reflected on the deposit side. So the purpose of this entire exercise is to kind of show you that there is indeed very low sensitivity of the demand for savings in dollars. That's the point. Because if that demand is somehow sensitive, then our story falls apart. But we're showing you that here is a significant economic shock to the cost of credit, and we see that you can lower even further the cost, the compensation on dollar deposits, and it's in line with this extreme where all adjustments are happening on the deposit side. Okay, so let me just recap what I have. And I showed you the two main building blocks of this. So I showed you the significant economic discount on taking your credit in dollars as opposed to soles. Then I told you, FYI, banks are just kind of stuck in the middle with a balance sheet that is nearly perfectly matched. Let's move to the deposit side. On the deposit side, on aggregate, we can see that the line of the deposit, the cost of the deposits moves with the cost of credit. Can we convince ourselves that it's really because of these deposits being insensitive, and this discount for dollar deposits originates on that side, on the liability side of the banks? And this is where I brought up this piece of evidence where I show you here's significant shock for the bank, and the bank's gonna adjust on the deposit side. And I didn't show you the graph. The fun fact was that even though the rates on interest on the dollars deposits went down significantly, actually the volume of deposits didn't go down, which is precisely why at the end of the day, by the end of 2016, the entire policy was erased in one big sweep because it was considered ineffective. What they were trying to impact is dollarization of credit, but they did not succeed in affecting the liability side of the banks, because they just, yes, indeed, they brought the interest rate on deposits way down, yet did nothing for the composition. So I'm going to skip over this because perhaps somebody has a question, but the results that I have left are more auxiliary. They kind of help us understand, but that there is a carry motive, because you can still have to think about, well, why would the borrower, yes, it's economically significant, the discount, but does come with a risk. And so this is where we go back to the carry motive. And this particular table says to you that in the cross section, when firms are doing worse, they're gonna do more of this carry trade. So if the discount on the dollar credit becomes more attractive. Skipping this is just kind of exploration into other potential motives. And I'm going to take a question from Ellie and maybe then conclude. Ellie?
Yes, I think this is very compelling analysis, Victoria. But I wonder, your focus has been on the dollar discount, but I wonder whether there's a kind of hierarchy dollar loans, euro loans, because they do borrow in euros, they do borrow in Swiss francs, and some of them borrow in Australian dollars. Is there a kind of hierarchy of which one's the cheapest and next cheapest and so on?
Yeah. Heli, you're thinking, and earlier you brought Japanese banks, and you're absolutely right that if you would take a country like Japan or perhaps European country, then we would observe a mix of currencies, dollar being the dominant one, but nevertheless several other currencies. That is not the case in Peru. In Peru, there is no other, dollar is a dominant currency. There are no other type of currency. And I think, yeah, so here I cannot do that. This is a very simple world with two currencies. It's a good point. And I do think that what you have here is true, except that I cannot test it in this context. I also want to be clear that I think that our story is more about emerging markets, because, and I mean, it would be very interesting to see if there is such discount exists in developed economies. I don't know, we don't have the data to think about that. But because here, as I said, it seems to originate from the liability side, which ultimately is rooted in this inflexible demand for dollar savings. And I don't think the same would be true for a country like Japan or several developed countries.
Okay. Thanks.
I'm happy to answer any other questions. I don't see anything in chat. Anela, I see your hand.
Hi. A couple of comments just sort of to follow on from that. Countries, I don't know what Peru's rating is. I'm guessing it's in the sort of below single A space. And a country that's say AA like New Zealand has more options, because if you look at the euro market and the yen market, you get more liquidity at the upper end, but the US market is kind of special in having those double Bs, single B segments that are reasonably liquid that people can issue in. So for much lower rated countries, yes, it tends to be all dollar in terms of where you can kind of get other derivatives to have that more complete finance. So I guess I'm talking about borrowing and covering it, and you're talking about local deposits. But I think the thing about the dollar, and I guess that's kind of my first question that I'm thinking about, is I really like the micro data and the way you go at the transaction level and you show that these shocks are passed through to deposits. And I wonder if that rigidity in the deposit side is really because those depositors are not looking for yield, they're really buying insurance. And whether this is 200 basis points worth of insurance because in bad times the dollar is strong and other currencies are weak, with the exception probably of the yen, because the yen tends to outperform the dollar. Yeah. Which would be Ellie's comment about other currencies, and maybe the yen would be different from the euro and pound.
That is a good point. That is a very good point. At the end, I mean, as I said, we are not trying to surprise the world that emerging markets like saving in hard currency. So I think that is a well-accepted fact, right? I mean, the reason why I'm spending some time here is on it is just to confirm that and kind of put magnitudes on it in this context. And it's especially important for us because the period over which we are looking, it's the so-called Peruvian miracle, because the economy was growing at some very high rate and it was in really fantastic shape. So that's why I'm trying to confirm it. But otherwise, I think that it is a well-accepted fact, at least anecdotally, that there is a people prefer to save in dollars. And I can tell you, when I was a Peruvian bank regulator, why would, like, the first thing I would do when I would be paid in soles my salary is me and my friends would go outside and change it in dollars immediately. That's precisely the motive, right? Because we would take zero chances, and that's the insurance that we were buying. The interesting, but I think that it is an important, what we do succeed to do in this study is, even though I think that there is a little bit more than that, and of course, this is outside of the scope of our paper, in persistence of those strong preferences. Because even though we are looking over this period that is an economic boom for Peru and a unprecedented stability, and still the demand for dollars is so inflexible that this discount still is this discount still is being pushed on the credit side, and is at the core of the and appears to be one of the core reasons why dollarization of credit persists. So I think that that's more interesting, that it's not only preference for insurance, but kind of resilience of this preference through all economic times in emerging markets.
Yeah.
I don't see any questions in chat. I see that there is somebody who can. Oh, there we go. There is another question.
Just a short. Sorry, can you hear me?
Yes.
Just a short question. So I would like to ask. This is out of the scope of the paper probably, but I would like to ask some of the policy implication from this paper. So, the cheaper dollar does not sounds like a bad thing maybe, but if it is coming from some banking regulation, the bank incentives could be distorted, and it could be the consequences might be there be less domestic lending or so on. So is there any policy implication you could drive from your finding, or is it totally
Absolutely
out of your scope of this paper?
No. I think that we can definitely use some of it. So I think that the core conclusion here is that there is a significant demand component on the credit side. Why is it there? Because there is substantial economic savings as a borrower that if I can do if I take on the dollar credit. Now, at the core of that is the fact that the deposits in dollars are incredibly cheap. I don't think the problem are the banks, but I think that the policy implication go along the way of the core of the problem is the fact that depositors are incredibly inflexible in saving in dollars. So if anything, it's hard to say what is the traditional policies that you do in those cases, right? But you, for example, could say what wouldn't work. And for once, if the specific things that we're looking at is going wild with your reserve requirements on dollars, apparently it doesn't work. Yes, it squeezes the interest rate further, but then that interest rate is kind of pushed to it even makes problem deeper, right? Because now this discount is going to pop out on your credit side, making dollar credit even more attractive to the borrowers. So that you see how the policy implication, it is a useful finding, maybe not so much in telling you, oh, this is a solution. It is a difficult problem, right? But instead, it's a very useful finding in saying things that will not work. And for once, reserve requirements will not work. It will aggravate the problem. See, that's the finding. Let me conclude, and I'll go with my family here. So the point is kind of enriching the narrative of this very important question of the prevalence of dollar credit. As I already mentioned, I think what we have to say is specific to emerging markets, But one thing that you keep hearing, at least in emerging markets, is that dollar credit is cheaper. That's why firms take credit in dollars. And so here we go after this specific question, and first and foremost, provide a clear measurement. Is it really cheaper? By how much? And the magnitudes that we find, the takeaways that significantly economically different after adjusting for UIP. And then the second leg of our narrative is that the root of the problem appears to be on the deposit side, and for the inflexible preference for savings in dollars, and even in the best of economic times. And the regulations that we have on banks, which force them to just kind of pass through this discount that originates on the deposit side, that kind of ties the narratives together, and that's what ultimately says, well, part of the reason is the fact that I'm going to save money at dollar if I take on a dollar credit. Hopefully, a very simple paper with an important conclusion. Thank you so much.
It was indeed, Victoria. We really appreciate it. This was a simple yet very nice, very powerful paper. And I also want to thank Ellie, Anela, and Iko with the questions. If Ellie, Anela, or anyone has one last question before we send Victoria back to her family.
It was a wonderful seminar, Victoria. Enjoyed it.
Thank you. Thank you very much.
Victoria, thank you very much for doing this at 6 a.m. in your time. We really appreciate it. And we really do hope that we can have you in our region one day at the Asia School of Business and in a better world, hopefully. In the meantime, thank you very much again. Have a great time with your family and stay safe.
All right. Thank you so much. Have a great day.
Thank you.